Welcome back. Here we are, the triumphant finale of our Financial Literacy Explainer series. Look, over the course of our journey together, you've conquered your financial awareness, you've mastered the art of budgeting, you've built up your savings, and honestly, you've ruthlessly killed off your bad debt. Take a second to appreciate that. You've earned this moment. But now that your financial house is in order, a new challenge appears. It's kind of like the ultimate financial boss, investing. Because right now, you've saved your money, but it's just sitting there, doing absolutely nothing. Today, we change that. We're officially shifting from defense to offense. We're going to take that hard-earned cash and turn it into a tool that builds real, lasting wealth.
But listen, there is a silent villain waiting for you. If your money is just sitting under a mattress or in some zero-interest checking account, you're not just breaking even, you are actually losing money every single day. Why? Inflation. Depending on where you live and what the economy is doing, inflation eats away 10 to 15% of your cash's purchasing power every single year, sometimes even more. Imagine working incredibly hard for your money, only to have a visible chunk of it just literally vanish into thin air, all because it was standing still.
So, we have this stark contrast, right? On one side, we've got the tragedy of stagnant cash. Money sitting, doing nothing, just slowly evaporating. On the other side, we have our strategic goal for today's explainer, putting your money to work while you sleep. The wealthy, they don't just work for their money. They force their money to work for them. They send their dollars out like little employees to go gather more dollars and bring them back home. That is the fundamental mindset shift we absolutely need to make today.
Let's completely demystify what investing actually means. You can forget the Hollywood movies showing frantic traders screaming on a stock exchange floor. Investing is not gambling. Not at all. It is a deliberate, mathematical action. At its absolute core, investing is simply buying future money with today's money. You buy an asset, that asset generates returns over time, and then you reinvest those returns. It's just a calculated process of planting seeds today so you can sit in the shade of a massive tree tomorrow.
And here is the mathematical magic behind the whole shebang: compound growth. Think of it as a snowball rolling down a hill. At first, it's small, it picks up just a little bit of snow. But as it grows, its surface area expands, and it picks up more and more snow with every single rotation until it is literally an unstoppable boulder. Your returns generate their own returns. The ultimate goal here is threefold: maximum growth of your assets, protecting the wealth you've carefully built from that silent villain of inflation, and ultimately securing your financial future so you have real options later in life.
But wait, before you invest a single penny, I'm going to put you through a rapid-fire interview phase. 7 vital questions you must answer. Question 1. How much? This is the golden rule of entry. You should never, ever invest your rent money. You should never invest your emergency fund. You only invest what is extra. The money you put into the market needs to be money you absolutely won't need to survive on tomorrow.
Question 2. When do you need it? Timelines absolutely dictate your actions in the investing world. If you need this cash next year to buy a car or, say, pay for a wedding, do not invest it in the market. Keep it safe. If you need it in 5 years, well, it's a maybe depending on your strategy. But if you don't need this money for 10 years or more, let it ride. That is prime investing capital. Which leads us perfectly into question 3. How long? Because the longer your timeline, the more risk you can afford to take. Why? Because time heals market volatility. Markets will go up and markets will go down. That is 100% guarantee. But if you have a 20-year horizon, a bad 6 months in the market is just a tiny blip on your radar. Time is the ultimate shock absorber for your wealth. Question 4 asks you to look inward. What is the goal? You can't hit a target you haven't set. Are you trying to save for a down payment on a house? Are you building a nest egg for retirement? Are you trying to fund your kids' university education? You have to define this right now because your goal entirely determines your investment strategy. A retirement portfolio looks very, very different from a 5-year house deposit plan.
Question 5. How are you putting the money in? Are we talking monthly or all at once as a lump sum? The psychological difference between these two is massive. Investing a little bit every month is called dollar cost averaging. It's super low stress. You buy when the market is up, you buy when it's down, and it just smooths out the whole ride. Putting in a massive lump sum all at once, though, that carries timing risk. If you put it all in the day before a market crash, man, that's going to hurt. For most of us, monthly contributions are the steady, stress-free path to wealth.
Question 6 really challenges your psychological readiness. Can you handle loss? You got to be brutally honest with yourself here. If seeing your portfolio drop by 20% in a single month would make you panic and sell everything, then you aren't ready for individual stocks. Investing requires a cool head. You have to be able to stomach the dips without abandoning the entire strategy.
Finally, question 7 concludes our interrogation phase. What are the alternatives? This is the golden rule of comparison. Before you put your money into anything, study the alternatives. And hear me clearly on this one. Never, ever invest in something you do not intimately understand. Seriously, if you can't explain how it makes money to a 5-year-old, keep your money out of it.
Okay, you've passed the interview. Awesome. Now where do we actually put the money? Enter the risk versus return ladder. Think of this as a staircase. As you climb these 5 steps from the bottom to the top, the level of risk increases, but so does your potential return. You have to decide which step makes the most sense for your current level of financial stability.
Step 1, right at the foundational baseline, the bank. This is your safest rung on a ladder. It offers essentially zero risk and a fixed predictable return, usually through something like a high-yield savings account or a certificate of deposit. Now the downside is it's probably not going to beat inflation over the long haul. But what it does give you is absolute safety, so you can sleep peacefully at night knowing your foundational cash is perfectly secure. Stepping up to level 2, we find investment funds. Think index funds or mutual funds here. The risk is still relatively low because you're highly diversified. Instead of buying one single stock and just crossing your fingers hoping it goes up, you're buying a tiny slice of hundreds or thousands of top companies all at once. You basically let the experts and the broader market manage the growth for you. It is the ultimate hands-off wealth-building machine.
On the third step, sitting squarely in the middle, we have gold. Gold is historically known as the ultimate safe haven. It's a physical asset. And what's fascinating about gold is that its true power really shines when the world gets chaotic. When the stock market crashes or currencies are fluctuating wildly, gold typically stands strong. It holds its value and fiercely protects your purchasing power.
Now we ascend to step 4, business. Whether it's starting your own project or investing as a partner in someone else's, this is a significant jump in risk. This isn't passive anymore, guys. It requires deep, intensive study, active involvement, and most importantly, surrounding yourself with people you thoroughly and implicitly trust. The risk is high, for sure, but the potential returns of a successful business are absolutely massive.
And finally, at the very top of our ladder, real estate. This is the classic heavy-hitting wealth builder. Buying land or property to either rent out for monthly cash flow or hold on to and sell later for a much larger profit. It requires significant capital to start, making it the boldest move on the ladder. But historically, it is one of the most powerful and tangible ways to build generational wealth. You start safe at the bottom, and as you grow, you climb bolder.
So the crucial point here is making sure you have the right foundation in place before you start climbing. To graduate to the next level, I need you to grab a pen and write down these 5 golden rules. Rule 1, have 6 months of living expenses completely locked away in a safe emergency fund before you invest. Period. Rule 2, build multiple income streams. Don't just rely on one salary. Combine it with a side hustle and your investments.
Rule 3 is a massive mindset shift about debt. Borrow to invest? Maybe. Borrow to consume? Never. This spotlights the absolute importance of avoiding consumer debt. Look, putting a new TV or a vacation on a high-interest credit card is financial sabotage. But taking on strategic, calculated debt, like getting a mortgage to buy an income-producing rental property, that can be a powerful weapon to amplify your wealth. You just have to know the difference.
Rule 4 is that you must budget forever. Budgeting is not a temporary crash diet, it is a permanent lifestyle choice to track exactly where your money goes. And Rule 5 brings it all together. Opportunities appear to the prepared. Listen, the market will crash. Real estate deals will pop up. Businesses will suddenly need capital. If you have been living these rules, saving, budgeting, studying, you will have the cash ready to strike when the opportunity of a lifetime presents itself.
Take a look at these milestones you've conquered in this 5-part series. You started with financial awareness, really figuring out where you stood. Then you implemented a strict budget. You built up a rock-solid savings habit. You achieved debt freedom. And today, you've unlocked the final level, investing. You have effectively transformed your entire financial operating system from someone who works for money into someone whose money works for them.
But before we wrap up today, I want to leave you with this triumphant final realization. You can buy all the index funds and real estate in the world, but the absolute highest return on investment you will ever get is investing in yourself. Buy the books, take the courses, learn new high-income skills, upgrade your mindset. Markets are going to fluctuate, but the knowledge and capability you build inside your own head can never be taken away. And I promise you, it will compound faster than any stock on the market. We've officially reached the end of our Foundational Explainer series, but honestly, this is just the beginning of your financial future. The map is in your hands, the ladder is built, and now it's time to take that very first step. So I'll leave you with this final, incredibly important question to answer for yourself. What is your first investment going to be? Take everything you've learned, make a plan, and take action today. Keep learning, keep growing, and I will see you in our next explainer.